Greetings, everyone. Welcome to Cutting Through the Noise, our monthly investment webcast. I'm Samantha Geyer, Marketing and Communications Manager here at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little bit about Tony and our firm. Tony is Partner and Chief Investment Officer at SignatureFD. He chairs our investment committee, represents us at various industry events, and has authored articles for the Wall Street Journal, Barron's, the Financial Times, and other industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. This holistic approach to wealth management is something we like to call net worthwhile. With that, I'll turn it over to Tony to get us started.
Thank you very much, Samantha. So there is a lot of economic data rolling in this week, and we're also getting a lot of corporate earnings results. And on top of that, a little bit of icing on the cake is we get Fed policy rate announcement here in a couple hours, where they're widely expected to hike interest rates another 25 basis points. So a lot of stuff going on in the markets, but today, and what we find to be helpful sometimes is to step back and really try to see the forest through the trees. So today we're going to keep things pretty short. We're going to focus on the high level. But if you have any questions, please submit them through the Q&A box on your screen. So what we have on the agenda for today is, first and foremost, the market has really been on a tear since October. And though we think the next bear market may be a ways off, there are good reasons to suspect that we're going to get a consolidation or some sort of corrective market action here soon. Now, inflation was the big driver of volatility last year, but it has subsided to a point in which other things just simply matter more for markets than inflation. And chief among those is really the sustainability of the economic expansion. So we'll talk about that a little bit. And finally, the bull market that we've seen that started in October, that's been led by expanding valuations. And that is actually a very normal condition for the first year or so of a new bull market. But the advance really should soon give way to rising earnings growth. And on that note, there are some good signs to point to. So first, we'll start with this. We don't emphasize historical patterns too much because every year is unique. But we do take a look at it at the beginning of each year. And we would note that this year has been tracking very well with historical trends. So what we're showing here in blue, that is the average of the market's 1 year pattern plus the average pattern in every pre-election year, and additionally the average pattern in all years that end in 3. So they kind of come together to create what you see here in blue. And in orange, that's what's happened so far in 2023. So you can see that it has tracked well. The cycle did point to a strong period through about the end of July. But now the cycle is downshifting into something that is more sideways in market action, followed kind of by a year-end rally in December. Now, again, we don't put too much emphasis on historical cycle analysis, but we do think that this framework for the rest of the year does make some sense based on various things that we watch. One of those things is market sentiment. So we do expect that the uptrend here should moderate, mainly because sentiment has gone from a pessimistic condition to now market sentiment is more optimistic. So here in this chart in orange, we're showing market sentiment as measured by several indicators combined into one indicator. Now note that sentiment was very pessimistic from early 2022 all the way to very recently. Now just in the last few weeks, sentiment has climbed into its optimism zone. Historically, optimistic sentiment has coincided with pretty flat market returns. Typically, that first run from pessimism to optimism, that's typically relieved by a pretty shallow correction. So that's our expectation here, is that any sort of corrective market action will lead sentiment to go back to a more pessimistic stance. Now, I'm sure everyone is pretty tired of hearing about inflation, and if that's the case, I do have pretty decent news on that front. The market seemingly moved on from inflation as the big driver of volatility. So here we're showing a chart of inflation in orange, and you can see that you got this definitive spike in inflation late last summer. Now, historically, when inflation has been very high and rising, market returns have been weak. But now inflation has fallen below its average rate of the past 5 years, and that's what we're showing in blue here in the bottom clip. The markets tended to perform well when inflation has been low or stable. So inflation is one of those factors that most of the time it doesn't really matter that much until it becomes abnormally high, and that's when the market pays a lot of attention. Fortunately, this has subsided to a point where it's not the main driver of market volatility. Now, inflation itself isn't really a huge problem for the market. Actually, corporate earnings tend to rise pretty strongly in inflationary environments. But it's what inflation does to interest rates, and that tends to be the real problem. So here in the top clip in blue, we're showing interest rate volatility. And we can see that volatility in interest rates was generally high and rising throughout 2022. Now this year, rate volatility has been falling, and that has helped to provide stability for all asset classes. And we can see that although the Fed has kept at it with their tightening campaign, 10-year Treasury yields have been very stable since the bull market in stocks began in October. So rather than inflation as a driver, it's more likely going to be the sustainability of economic growth that could drive the longevity of this bull market. So here in blue, what we're showing is global stocks. Now in orange, we're showing a calculation of the probability that we're in a global recession. Note that the probability of global recession was high and rising throughout much of last year, and that coincided with that bear market. But this year, the probability of global recession has been plunging. Historically, the markets performed well when recession probability has been falling, and in fact, the big bear markets really have only come when global recession risks are quite high, and we're going in the opposite direction here today. Now, astute listeners, you may point out that the market tends to lead the economy, not the other way around, and that is definitely true. So this chart here plots the economy in blue and the stock market in orange. Recessions are shaded here on the chart. Now, the stock market has almost always turned lower ahead of the economy. And lead times vary, but on average, the stock market leads the economy by about 2 quarters or so. So as long as we think that recession is over 2 quarters away, it's more likely that the path of least resistance for the stock market is higher rather than lower. Now, so as for what we believe in terms of when recession is going to get here, we do think that recession is more than 2 quarters away. Most of my favorite indicators that I like to feature, they're extremely simple, and this is an example of that. So in blue, in the top clip, we're simply showing the unemployment rate. The unemployment rate also has leading tendencies for the economy. It tends to bottom and start rising an average of 7 months before the economy. So the unemployment rate is a useful indicator for the stock market because it also leads the economy by roughly 2 quarters. And for now, the job market remains quite strong. Now, it seems like we spent a lot of time this year debunking bearish narratives that are out there. Most recently, it was that market leadership was too narrow. There weren't enough stocks advancing. Now, here's the latest thing that I've been seeing, and that's that the advance has been led by higher valuations, but earnings are still contracting. And that sounds ominous. And that part is absolutely true. Now, here is in green, these green dots, they represent the return for stocks in each of the major global regions over the past year. Now, let's highlight the United States. It's returned about 20% over the last year. And what the pink bar here is showing is that valuations have gone up by about 25%. Earnings, shown in blue, those have contracted by about 6% over that same time frame. So while that might seem ominous, if we go back and we look at historical trends, this is exactly how bull markets tend to work. The first stage of a bull market, earnings are often still contracting, and valuations are therefore going higher. We would be more concerned if earnings, if they continue to fall here in the next few quarters. But the pattern we've seen so far is no different than the pattern that's seen in almost every bull market. And we do expect earnings growth to become positive soon. So one reason for that is that analysts covering these companies expect earnings to turn higher. So here in red, we're showing the percentage of the market where analysts have been ratcheting up their expectations. And you can see it's now at a pretty historically high level. And all that means is that analysts that cover these companies expect earnings to improve in upcoming quarters. Now, historically, the analysts have been directionally accurate. Earnings have tended to rise when their expectations are improving. So we think that earnings growth here may turn positive again as early as next quarter, which could be good news for the sustainability of the market advance. So to summarize the main points from today, we do think there's good reason to expect that some corrective or sideways market action could happen pretty soon and in through the fall. But that's not yet likely to be the end of the bull market. Inflation has been a variable that historically just hasn't mattered that much unless it's an outlier reading. And we had that last year. We certainly had outlier inflation last year, but it has since normalized to a level that the market has spent less time focused on it as a main driver. The focus instead for the rest of this year and into next year is going to more likely be on economic growth. And finally, major bear markets, they've tended to coincide with global recessions, and recession probability has actually been falling of late, not rising. And it's not abnormal for valuations to expand in the first leg of a bull market. Eventually, the baton should be passed from rising valuation to improving fundamentals, and we do think that could happen as soon as Q3 of this year. So that's what we have for today. Here's our important disclosures. And just checking in, it looks like we have no further questions for this month. I want to thank everybody for calling in, joining us with your time today, and I wish everybody a happy rest of your Wednesday. Thank you very much.